Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down ABB, the Swiss multinational specializing in automation, electrification, robotics, and digital solutions. ABB plays a central role in industrial automation and the global energy transition. The big question is, how does ABB stock stack up based on the fundamentals? We'll evaluate ABB using our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. We look for companies leading their industry in capital returns, showing they know how to turn investments into real profits. ABB delivers a return on invested capital of 14.7% and a return on equity of 27%. Looking first at return on invested capital, Siemens Energy is at -0.1%, reflecting recent operational struggles at Siemens Gamesa. Schneider Electric is at 9.5%. GE Vernova sits at about 1.7%, though limited historical data makes this less reliable. ABB leads the group with 14.7%. Now on to return on equity. Schneider comes in at 14.6%. Siemens Energy is slightly lower at 13%. GE Vernova is higher at 16.4%, again based on limited data, and ABB tops the group with nearly 27%. Clearly, ABB dominates this group, showing it's highly effective at turning invested capital into profits. High returns on capital should translate into strong earnings growth over time. But does ABB's performance actually live up to that promise? Over the past decade, revenue grew at a compounded annual growth rate of -0.9%. But if we exclude 2015 as an outlier, ABB achieved 3.5% CAGR. Net income grew at a CAGR of 8.2%. Earnings per share grew at a CAGR of 10.5%, faster than net income due to stock buybacks. So why is earnings per share growth lagging despite ABB's high returns on capital? While ABB is highly efficient at turning invested capital into profits, moderate revenue growth and cyclical industrial demand limit overall earnings expansion, and stock buybacks have been needed to boost earnings per share growth beyond net income growth. Compare this to Schneider, which posted 4% revenue CAGR and 13% earnings per share growth. While ABB's top line hasn't been as strong, buybacks have helped earnings per share grow faster than underlying profits, partially compensating for slower organic growth, but not fully reflecting operational strength. Strong growth is only sustainable with healthy financials to back them up. Cash and short-term investments sit at $5.6 billion, and total debt sits at $8.1 billion. Debt to equity is 0.5 and has been improving from 0.7 in 2022. With a free cash flow of $3.8 billion, this results in a free cash flow to total debt ratio of 46%, where 10% is the bare minimum. So ABB can't fully cover its debt with cash alone, but its leverage is moderate and trending downwards. With strong and recurring free cash flow, ABB's financial footing looks solid. Even great companies can be poor investments when investors overpay. So how is ABB valued today? ABB trades at a price to earnings ratio of 29.7. By comparison, Schneider Electric is at 27.9, Siemens Energy is much higher at 84.9, and GE Vernova is extreme at 153.1. So ABB is priced similarly to Schneider, but far more reasonably than Siemens Energy or GE Vernova. Now let's add the PAC ratio for a growth-adjusted view. Analysts expect ABB's long-term earnings to grow around 9.4% annually. With a PE of 29.7, that gives ABB a PAC ratio of roughly 3.2. To put that in context, a PAC of 1 is often seen as fair value, while anything above 1 suggests investors are paying a premium for growth. And above 2, that premium looks steep. At 3.2, ABB's valuation looks stretched, especially given its moderate forward growth. This leaves little margin of safety for long-term investors, meaning any slowdown in execution or demand could hit the stock hard. Strong returns and growth only matter if they can last. So let's examine ABB's moat. ABB's strengths are that it's a global leader in industrial automation, robotics and electrification. It has a strong customer lock-in through integrated systems and software. With geographic diversification, with a deep presence in Europe, North America and Asia. But there are risks. Growth has been less consistent than Schneider's, with some cyclicality in industrial spending. Competition in automation is fierce, including Schneider and emerging Asian players. While ABB has efficiency leadership, it doesn't dominate digital platforms the way Schneider does with EcoStruxure. Overall, ABB's moat is grounded in automation excellence and capital efficiency, but not untouchable given intense competition. Before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Here's what our 5 key factors reveal about ABB stock. Return on invested capital of 14.7% and return on equity of 27% is best in class. Better than Schneider, Siemens Energy or GE Vernova. Earnings per share grew at a CAGR of 10.5% over the last decade, partly fueled by stock buybacks. But moderate revenue growth and cyclical demand limit long-term upside. ABB has moderate debt, strong free cash flow and improving leverage. A price-to-earnings ratio of 29.7 and a PEG ratio of 3.2 indicate a rich valuation with little margin of safety. ABB is strong in automation and robotics, but competition and lack of a dominant digital ecosystem are challenges. ABB is a capital efficiency powerhouse with moderate earnings per share growth and healthy financials. But at today's valuation, investors may be paying too much for future growth. With a PEG ratio of 3.2, the margin of safety looks thin, leaving limited upside and more downside risk if growth disappoints. What do you think? Is ABB the automation leader worth owning at today's price? Or is it too expensive given its growth trajectory? Drop your thoughts in the comments, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.